Well, good morning once again. And again, thank you for joining us this Wednesday morning. Messer Financial sponsored webinar training on life insurance sales. Many of you I know have been working through this from the very beginning, all the way back in March, as we've progressed through all the steps that you need to take in order to prepare and design and present and sell a life insurance policy. We did a brief class earlier and we discussed or looked at some illustration skills. We used the simplified version of the life illustration product available on the Messer website. So hopefully you've all had a chance in the past to work with that, go over to the Messer site and do some very basic illustration. It's really not illustration, it's more of a quoting tool. Just gives you the numbers on term products. And then of course, there's one little extension on it that allows you to get the numbers or the premium costs on a guaranteed UL product. So that's a nice little benefit. Kind of fits in line with what I've been discussing, that when you're working with term products, obviously the lack of permanency versus going into the permanency of either ULs or whole life products, that the first step in the permanency on a UL is the basic guaranteed UL, which of course allows you to fix a premium for your client for the rest of their life. With the caveat that some products are offered to age 90, some to 95, to 100, to 110, to 120. So that's part of the focus that you would look at when you're presenting that type of a product. But again, it's a numbers base only. Eventually, if you do sell any UL product or any whole life product, you have to attach and have a signed illustration to match that product that you sold. So today we intend to go to that next step in greater detail with some advanced illustration training. And of course, what we're going to use today is going to be the WinFlex web. As always, just a couple of bits of housekeeping. Everyone's phone should be on mute. And please, we would ask that you stay with us until the end so that you get all the information. Again, the webinar itself is being recorded. It will be added to the Messer website, to our Learning Center, which you can find easily by going to the www.messerfinancial.com site and looking at Agent Resources. On the drop-down, you'll find the Learning Center. And that's where the posting will take place for any of the webinars that we've had the opportunity to present to you in the past. So even those that you missed or those that you might want a little brief refresher on, you'll be able to rely on that tool to go back and take care of that information. So as we talk about the WinFlex web, we have our first polling question of the day, if you would please, Rebecca. And again, what we're trying to determine is, in the past, I have brought to your attention the need for registering on the site, and I hope that you have taken the time to do it. And if you would answer, that would be great. And if you haven't had the opportunity to go in there and do that, we'll talk a little bit about that in a moment as we open up that part of our presentation. So with better than 3/4 of the vote in, we seem to be right at a 50-50 split. So for some of you, the information I'll be showing will be relatively brand new. For others that are registered, you've had the opportunity to take advantage of it, perhaps, and use it and test it. I'm going to say that's primarily one of the things you need to do when you begin to work with illustration tools of this nature. You do need to actually go in there and work on it. I mentioned earlier that one of the parts of my career background is a time that I worked as a agent for MetLife. So being a captive agent, of course, I was under the realm or the thumb of an agency and management of that nature, with a good hands-on to do ability. But what I had to spend a lot of time with personally was running illustrations. And I did that on my own because that was the best way that I could learn what was going on behind the scenes with these products. You do, of course, have the luxury as a agent with Messer Financial that if you should need assistance on illustration, you could simply call in and ask for that support from our producer support department at extension 813. And Chris and his team will be glad to help you there. Also, you have the ability, once you're appointed with these companies, to talk to their sales desk, and they too will help you with the illustration work. I hate to take the tool away from you because I feel it's important that you be well-rounded and you know how to use it. But I'm letting you know that you do have a couple of crutches in case you find the work with these a little bit beyond your ability at this point, which is okay. Again, it does become a learning experience. So as we've asked before, please do make a note for yourself if you haven't already to go to the WinFlex web, which is the www.winflexweb.com. You can see that up in the upper corner here of the sign in. Once you do, you'll either have to register as it indicates for the WinFlex site if you've never used it before, or if you have registered, of course, you're going to go to the login page. Now you'll create your own username and you'll create your own password. And once that is all in the system, that's the simplest first step to the actual login itself. Now, when you do become appointed with a carrier, that is going to be what's going to allow you to have access to this tool. The beauty of the WinFlex tool, again, is that all the information you're going to receive on this is current. So like every night, the system is recharging and adding any changes that might have taken place, anything that might have had to do with the interest rates, the structure of the products. You do not have to go to a site and pull it up and download it and wait for your system to take it and then open it and then save it and then do all that stuff. So no need for that. Just use the WinFlex tool. It costs you nothing. Okay, that's important, I know. Agents often ask me what's my cost on that. And again, it's a tool that's available to you at no additional cost. Now, as you see here, it's got some information on the top talking about the number of WinFlex runs that have taken place, the average death benefit, and the average premiums that are out there. That's here nor there. When you're looking at the work we're going to do today, we're going to be using the illustration tool, not the express one. You'll be able to establish and set up with your book your client manager so that when you come to it at any time, you can always go and look at your own book. Of course, your user profile will be established when you first set yourself up. Additional information on management and also the ability to go ahead and do an e-application or check the status on one that's in process. So everything is at your fingertips here, and it's relatively easy to find. If there's new things taking place by the carrier, that'll be highlighted over here. Protective, I know, has just this week released some new life products because the life product that you may have been working with before that you thought was a term was one of those term products that was built on a type of a UL chassis. It had to do with the costs of the insurance, keeping it down at the provider, but we won't get into that detail. But they have now reissued a straight term product. Mass Mutual, we're going to go to their site this morning to do some illustration work. Again, that's a carrier that you have the pleasure or the opportunity to get appointed with and not be captive. I've talked many times in the past that when I look at the top 3 companies, as I call them, in the true life business, those with the largest bank, those that have been around the longest time, those that are the most secure, are New York Life, Northwestern, and Mass Mutual. And unless you want to go captive, you can't sell products for New York Life or for Northwestern. So you have an opportunity to become appointed with the carrier that does have captive agents, but also works through a brokerage network. And we have that working relationship here at Messer with the Mass Mutual offices, both locally and for those of you who are joining us today that are out of state, we can get you appointed with Mass Mutual as well. There's a couple little steps that we take, or that they take actually, to get a clearance from what might be a protective area in the state that you reside in, but you'll still be able to work out of our office and work through those Mass Mutual cases. We've also worked diligently this year on the American General Partners Group quality of life, because we've been looking always to make sure that as agents, we're doing what's the most important thing, and that's the best job for our client. And as you're aware, one of the biggest changes in the industry in the last couple of years is adding those living benefits to a term life product. There was no such thing just a couple of years ago. If you wanted critical illness or chronic care, you bought separate policies for cancer, etc. Now to know that you can blend it all into a life policy, it gives a lot more meaning to a term life product than it really ever had before. But again, we're not going to use AIG today in our permanent work. We are going to go to Mass Mutual. So first step, again, to the top corner in the shortcuts, we want to click on illustrations. And what's going to open up now is a basic box of information. Again, it's going to log in things for you that would be clients that you've had or worked with in the past. So you'll have them on file anytime you want to go back and look at them. You could just simply select one, and once you click on it, it'll come back up on the screen and bring you back to the work you had been doing. Again, it's got all the information on the side that we saw on the first screen about some news or new things with the carrier. And what we want to do today, though, of course, is going to start from the very beginning. We're going to start a new case. Now, once you open the door to the new case, this is where you're going to make your selection of the carrier. Now, remember what I said. When you are appointed with the company and you request the access on the WinFlux web, you get registered by the company approving you by saying, hey, this guy does or does not have an appointment with us. So as you can see, the carriers that I'm working with that I can present to you today are those that I personally have my appointments with. And as I mentioned, we're going to go to the Mass Mutual company for this presentation today. And once you choose the company, you're going to get a list of all the products. Now, also, when you get a list of the products, it's going to help you by giving you product notes and information. So the Leg 100 is actually what they call their Legacy 100 product, and that is a premium participating life insurance policy with those level guaranteed face amounts payable to age 100. And then the last payment would be made at age 99. And then, of course, at that time, the policy has completely matured. It's paid in full, and the benefits are there. Now, a 100 legacy pretty much is the old standard. All life insurance policies that were once written were done to age 100. Then changes took place, and you're going to see as we go through these. For instance, here on the HECV, if we chose that product, we would find out that it's a whole life, high early cash value, that's what the initials are for, with a level premium, and again, a participating policy providing the guaranteed life coverage. In this case, this product has premiums that are payable to age 85, again, at which time the policy is guaranteed to be paid up, and the high guaranteed cash values are built up during the policy's early years. So this would be, I guess, for lack of a better term, a product you would use for what would be called cash accumulation. Also, you're going to see leg 65. So again, it's the legacy 65. And in this particular product, again, a participating policy. And we'll talk about that in just a second, where premiums are going to be paid to age 65. Then you have a short window where you can work on a life policy and pay it all up in 10 years. A little longer, pay it up in 20 years. You have the Care Choice product, which is a single premium whole life product with the built-in qualified long-term care rider. Qualified long-term care rider, meaning that this is one that would be acceptable for partnership for taxable positions at the eventual need. And it also has an optional inflation protection feature. And again, if elected, the long-term care benefit pool would increase annually at a 5% compounded rate, which is what builds in the partnership benefit. Minimal is 3 by law, and they build in a 5. And then the long-term care rider has a partial return of premium feature. So a lot of nice benefits. It's a relatively new product with them, but it's a very good product. Then we can get into the variable product. This is a variable universal life. Of course, to sell this product, you must be a registered agent. So you must have your series license, your series 6 and 65 or 7 and 64, whatever it might be. So highly unlikely you're going to do much of that work. Usually those are agents that are captive. It's part of their program with the carrier with their allegiance. We have a couple of different UL products, the Navigator, which is the old-fashioned flexible premium. And this one illustrates out to age 121. So again, in that case, with this UL, basically you're telling your client that they will be paying payments the rest of their life. You have the UL Guard product. Again, the product, excuse me, with flexible premiums. And then you have the account values with the premium guarantees. In our training in the early stages, we talked about one of the benefits of a survivor product. That would be for a second to die, if you're not familiar with that. Second to die meaning that, yes, you do insure both a husband and a wife, or two people, and the policy will not pay a death benefit until the second person dies. So you would ask, well, why would you do one policy for two people and not have a death benefit on the first? And these are usually used in estate type of planning tools, because as you'll see here, the permanent policy is written on the two lives, but it allows for one of those to be an uninsurable person. So you will run into situations where you want to do a life policy on someone and they're just totally uninsurable, which leaves you one option, and that's going to a death benefit for guaranteed purposes, more or less sold on those final expense type of products, which are going to be very limited in the face amount of dollars that you can ever write with that guarantee. So what happens here is you get to bring in two people, and the underwriting is done in such a fashion, recognizing the fact that one is uninsurable. Hopefully the other is in relatively good health condition, so that when the product is underwritten, it's done with a blending type of underwriter. We won't get into that part of it today. But again, it's going to have that death benefit available to that estate upon the death of the second person. So there's two survivor products right there. Again, the leg 100 being to age 100, or a 20-year type of product that you could write out again. Okay, so when we get into the other products that we have here on the single whole life products, on the SIP, as you can see here, in the survivorship whole life on this one, more detail. Again, a UL with joint ownership with the second to die with a flexible premium. Okay, so that means that's going to be paid out all the way out to age 121 again too. And then we go into the term products. And today, again, we're not going to focus on term. I would say, though, if you do find yourself interested in selling Mass Mutual products, you would probably be interested in the term products, not because they offer the living benefits, which of course they don't match up to those that we're working with. But one of the best things about their term product is, of course, the conversion benefit that would allow you to go to any of the permanent products that we've already touched on. And probably, as I've always said, and I consider the most important one, is the waiver for premium due to disability that you would attach to a term product like this, so that in the event something did happen, they still would have the opportunity to convert, and literally they could convert this term product to a permanent product without any necessity of underwriting. So if you keep that in mind, that's a huge option for a family, for a person to know that they've got that term product. And let's say they have 500,000 and maybe they intend to do a conversion down the road and do some permanency. And even if they don't, if they have that benefit and something occurs in their health condition and they would not have been insurable to go onto that permanent product, again, they'll be able to convert internally, and also it takes over. So the best benefit of adding and always using, as I say, in permanent products, that benefit is, of course, that the company then takes over the premium payments. So what I just said was, if you had a $500,000 term and you had a disability and you converted to a $500,000 permanent whole life product, the premium, of course, would be much greater on that whole life product, but the benefit of that waiver of premium on that disability plan would have made it possible now to have the company make that premium payment for you on that whole life product, which is absolutely huge. Okay, so enough said on that. Let's go ahead today, and what we're going to do is I want to go back to our imaginary client, the Anderson family, Thomas and Louise, and I want to do a product today first on doing some retirement planning. So this is going to be the vehicle I prefer to go to. It is my go-to provider. It is my go-to product. And when we're doing it, of course, I'm going to deal with whole life. I'm going to deal with the options available in the 100, the 65, 10, and 20. So I'm going to take into consideration the client's age. Now, if I'm building a retirement plan, as we're going to for the Andersons, who happens to be 35 years of age, as we'll input here in just a moment, I could do a program for him for 10 years and he'd be paid out at 45. I could do a program for him for 20 years and have him paid out at 55. But what I'm going to choose to do today is going to have him be paid out at age 65. And we're going to use that as the average age you're planning for retirement, of course, based on both Social Security and Medicare. And then we're going to talk about how we're going to get him a nice retirement income. So again, all the way back to the beginning, we select our company and we come over and we select our client, our product. And then we just come down below to create the client. Okay, there it is. So what we're going to start with this morning, again, we're going to work with Thomas. And again, this is Anderson. We know male. Thomas's date of birth was 01/01/1982. So, yeah, his issue age now is 36. And again, they show the same thing, the retirement age thought of 65. It's got non-tobacco. Don't worry about the life expectancy and being specific there. Not an issue. The non-tobacco, of course, is the fact we said that Thomas was in good health. We're not going to have any health ratings, so we don't have to worry about adding on temporary or permanent flat extras. We covered a little bit of those items in our work with underwriting. So again, if you want a little bit of backbone and information, you could go back to the presentation on underwriting that we did and get a little bit of area of understanding there. I wouldn't worry about changing the tax bracket. That's pretty much an average, but if you wanted to, you can change it. Most important though, make sure that you get your right state. So we might have people with us today in Alabama, but I'm going to use North Carolina, but you can see all the states are listed that this product applies to. Now I bring that to your attention because sometimes when you go into different products with different companies, they are state sensitive. There are products that are out there only for the state of New York, only for the state of California. And if you select one of those products and you go to add your state and it doesn't appear, that's going to be why, because it's going to show only that one opportunity, California or New York. They say that unisex is required if it's a contract in the state of Montana. And an agent license is required if this contract is in the state of California. And again, the agent's phone number is recorded. So these are just some important bits and pieces for you to know, not applicable to any of us today, I don't believe, on our call. Also up here in the corner is 0 errors. We got a lot further to go here today, but again, anytime you make a mistake, it's going to tell you. And when there's an error, it's not going to allow you to calculate. So right now we're good. So now we're going to look at a little bit of design work. Now we already know we're working with the Legacy 65. It's up here in the corner. If you did want to change midstream or at any point, as you just saw, once I brought my cursor on it, it opened the door to the other products that we could work with. So you could make the change there. Also, if you wanted to, since we're going to establish this today, and we're going to have Thomas's in there, you can see already. Let's just say we run one illustration one way and we want to do it with a different product or a different period of time. We would go ahead and we would use the tool down here that copies, and it would recreate another Thomas Anderson for us so that we could go back and make the changes. So you can be saving different ones as you're working with them. Okay, now for simplification today, we're going to leave it on a base design, but if you open that up, it's going to be base design with LISR and base design with LTC, which is long-term care, and the LISR is a life insurance rider. So you may have heard of that before, and that's where you can build a permanent product like this, a whole life policy for one face amount, and add on additional life insurance on a term basis. That's what the other part would be on the LISR. So it would be a blended product that would have life insurance for X number of years and permanency for X number of years. As you can see over here, again, is a description of what's taking place and a lot of information that you might need to know about the product. The base with the long-term care only is going to issue between 18 and 60. So if you got a 65-year-old that wants a life policy with a long-term care rider, this is not the solution. Okay. So anyway, if you did that, it would tell you had an error anyway. All right, so let's go back over here and let's do a traditional policy. We're going to have a monthly premium. What we're going to say today is we don't have a face amount that we're going to plug in. And what we're going to say here today is that when we started working with Thomas, he was selling cars at the Hickory Toyota location, and he was making about $60,000 a year. And that's what we worked with him on his policy and for Louise. But since that time, when we've done our policy review, which we've talked about in other classes most recently, we found out that Thomas has now been promoted to the sales manager at Hickory Toyota, and he's had a major increase in his income. He's definitely going to be making six figures going forward. So haven't been any changes in his household. He's still got the two kids. The relationship is still good with Louise, and he's just making more money. So sensibly, he's saying, hey, you know, Mark, we talked about in the beginning some of the things that we might like to do, and one of those was doing some more retirement planning. But when we worked together a couple of years ago, I wasn't in the position I am now. So I'm asking you to help me design a plan that would work for my retirement. And that's where we're going to go to from here. Now, oftentimes I get calls from agents and they tell me, you know, they want to build a retirement plan for their client. And I ask them, well, that's great. How much is your client willing to commit to a month for that retirement plan? And, you know, they tell me, oh, they want to do $100 a month. And they're pretty happy with that thought. Well, you can't do much with $100 a month. I'm just going to tell you face out. If you take $100 a month times 12 for the year, you've got $1,200. If you do that for 20 years, you've got $24,000. What do you think you're going to build in retirement over 20 years with $24,000 that's growing at a rate of $1,200 a year of your investment? What type of a return? My God, if you got 100% return, you'd only have 48,000. That's not enough to retire on. So you got to get realistic. That's one of the first things that agents need to realize. Retirement planning with the life insurance vehicle is designed for those that are willing to make some sacrifices and put some additional funds behind it in order to make this work. So again, with Thomas, we said we're going to use about 100,000 as his magic number, even though we know he's going to make more. And he was making 60. So he's got $40,000 more in income than he had when we first met. I'm going to go with what I feel is the best number for Thomas. And it might seem strong to you today, but this is the amount. We're going to do it by premium and not 300. I'm going to suggest that Thomas provide $1,000 a month. And you're probably sitting there saying, oh, wow, that's a lot of money. And believe me, it is a lot of money. Again, if we take that same premise of 1,000 versus 100, so we know that over the year, he's going to invest $12,000. And if we just said the 20 years, he's going to invest $250,000. That's retirement planning. That's going to work. Okay. So let's just see how well this is going to work. On the dividends, and that's the participating portion. I missed that earlier when we read the different types of policy designs. It said participating life. This is a mutual funded company. The owners of the policy are also owners of the company, so they are participating in the profits, and those profits are reflected in dividends. And we're going to ask that we keep the dividends here as a paid up additions to the policy. So as the dividends are being paid, they're not being paid to the client, they're being paid back into the policy that's buying more insurance. Now, if they wanted to get those dividends paid to them, they could. If they wanted to apply those dividends that they have to perhaps a loan or interest that they've taken out on the policy, they could. They have options. We're going to write the policy today on the illustration with paid up additions, but at any time in the future, if they want to make some changes, they'll have that ability. The loan rate, we're going to leave adjustable. We could go in there and we could make it adjustable and increase it, or we could make it fixed. Don't use a fixed product. It doesn't work on the illustration runs as well. Leave it at the adjustment. If you want to make the loan rate higher than the loan rate that's adjusted today, which is going to be the current market, you can increase it, as it shows again in the box over here. You've got all that information. So it's kind of, every time you go to one of these areas, it's going to give you some answers again to work with. Again, we're going to keep it simple. We're not going to use an exchange today with Thomas or any other funds from another policy. This is brand new business. Okay. Our next file that we're going to open is the options. And this is going to be non-qualifying because these funds are going to come after tax money that he's putting into this policy. He's not building with this policy on a qualified tax basis so that he's using pre-tax money. Excuse me. We're also going to have the dividend rate that the policy is going to illustrate. We're going to use current, meaning it's going to illustrate throughout this entire policy as if today's dividend or declared dividend for 2017 is going to be the same throughout the policy. If you chose to, again, I'll go down here and open it and reduce that, you could do it if you think it's going to be less. They've been so stable with the area of their dividend over these years that, again, I'm going to use a current dividend as my illustration program. Policy owner is going to be the individual. Again, though, you could change it to who's going to own the policy. Could be the business, again, could be used as a key man, could be built into a trust. Just going to leave it this way. And we're going to print, or we're going to use the max time all the way out through on the product. Okay, pretty simple so far. Now we're going to get into a little bit of work. Okay, so here's our riders. As I mentioned, I don't think there's ever a time that you should write a life and policy and not include the waiver of premium. So there it is. I'm going to include it here today. I don't have to do any ratings because, again, Thomas is in pretty good health. We're going to leave it at that. We're not going to add a renewable term rider. We could add guaranteed insurability rider and additional life insurance riders. So let's just go ahead and give him that. Guaranteed insurability. And we're going to include that rider in that actual premium. Okay. I want to go back here because as I'm thinking, where did I pick out? Oh, class rate, I left him at non-tobacco, and we discussed on Thomas that he was in very good condition. I never like to use the ultimate, the highest end, so we're going to use select preferred with Thomas. Sorry, I missed that we have to go back. Again, let's go back and make sure I didn't miss anything on the rider screen. It's going to be such a large policy that I'm not going to get concerned here. I'm going to take this back out on the guaranteed insurability rider. And now comes the work. We're going to talk about disbursements. This is where we're going to design this product to give him some type of a retirement base. So there will be disbursements at some point. And you can read into the benefits here. The retirement benefit option information, the concept tab, it's going to get into it. But let's go ahead and open it first, okay? The most common way to work this is switch at base. You do have options to do loans, to do surrenders, to do varying surrenders, and this could be done depending upon the type of product that you're designing based on it being a business loan. The switch at base, though, is the easiest one to work with because what's going to happen is it means the disbursements are going to switch at the base at that time. And this is where when they start taking disbursements, they are still a loan, but they're a loan beginning against what would have been the cash value accumulated from the payments into the policy, and then continue as a loan on the policy to eliminate the event of any taxable consequence. Now, the disbursements, we're showing 0 here to begin with, but we got to pick something. So what I want to do is I want to solve for the max. I could solve for less, 50% of the max or 75, but I really want to show the max that he's going to be able to receive. And then I want to work with borrowing from the policy. Again, I want to borrow. I don't want cash. I want to be able to, again, disperse monies in a loan fashion that are a non-taxable event. I could repay loans, but that's not the intention today. Repay loans might be, if we're going to use this policy as we build value, to borrow against it to perhaps buy a house, down payment, perhaps buy a car. The theory of bank on yourself. So you've got a policy and you borrow the money from yourself, from your policy to buy your car, and rather than pay the automobile company or the lender for that time period, you pay the loan back yourself, to yourself by paying it back to your policy. That's where that theory comes from. But we're going to simply make this a borrow from the policy today. We're not going to be interested in this to repay the loans, okay? And on this max here, I want to open up the window here to solve. And when do I want to start this? Well, I want to start it. You have a tab here. You can choose year or age, but I'm going to choose age. And I want to, again, have Thomas pay for this policy until he reaches age 65. And then he goes into his retirement. Now at that time, he's going to have, because we said he was 36, he's going to have about 29 years of build on this policy. And what I'm going to suggest is not starting to take disbursements until he reaches age 67. Okay. And I'm going to end it, not going to take it out to the max. I'm going to say, okay, let's take this out until your age 90. And you'll see what that does as we go into the review of this illustration here momentarily. So it gives you a lot of detail over here that I'm not going to get into for the element of time. But again, this is where your learning comes in when you start playing with this stuff. If you're doing it wrong, it's going to give you an error message. So you might have to read what was here and what maybe you should have done differently to make it right. But so far, we're good to go. On our reports, we could add additional information to it, the value of whole life insurance. I'm not going to get concerned about these. If you wanted to add a report to show mass dividends, because that's one of the things they want to know about, what have the dividends been like? Well, let's just go ahead and throw that in there, okay? And that should do it. You, of course, will put in your personal information as the agent so that everything you have, excuse me, is going to be pertinent to this illustration itself and to you. And then you're simply going to click on calculate. Now, depending upon how much information is built into this, it's going to take longer in some cases to calculate than others. This one won't be that long. Sometimes, though, you might be sitting there and thinking it's taking forever, and it is, because sometimes there's a glitch and it's just not working. Okay, so here is our completed illustration, and everything ran fine. Now, what it tells me is, without even opening it up, first of all, with $1,000 a month, he's actually purchasing $663,439 worth of death benefit. So I'm actually going to go back in just a little while after we do some illustration work and change this to a death benefit. Excuse me. I'll probably round it down to 660,000. The premium be a little less than 1,000. Or we could round it up and make it a little more, but I'll probably round it down. And we're showing on this again that he's going to pay for this from age 36 to age 65, so for a total of 29 years. It's also showing on the guaranteed side of the years, again, he's a 36-year-old individual, and we're adding on the 63 to take it to age 100. All we're going to do now is look at the illustration. There's also presentation tools available, but let's go to the illustration first. So again, it's a great design. All of your pertinent information on your client and you is right on the front cover. As you're working with these products, of course, you're going to be going into a learning curve. So you're concerned about, well, what happens when the client asks me this question? What happens when they ask me this? That's the benefit of these first 6 pages. You notice here, page 1 of 6. This is really not the illustration. This is the value of whole life insurance. So it gets into descriptions. It tells them that we are including in this one the waiver of premium. But you can, again, read about what the dividends are. We have a nice chart showing the cumulative value, the net cash value, and the net death. And the net death benefit. Basic information based on the guarantees. I'm not going to get into a lot of that today again, but showing some of the non-guaranteed information based on his rating, the amount, the premium. And now we're at the illustration itself. Now, this illustration is going to be 15 pages. Very, very important. When you run an illustration and you turn it in with an application, you must turn in all 15 pages, not just the signed page, as agents have been known to do, but the entire presentation. So again, we've got our pertinent information on Thomas. We're working with a whole life policy paid up to age 65. With the paid up additions, we're looking at how that monthly payment is broken down. You can see 979 of it is premium, and an additional $20 is the waiver premium. Again, I'll show you how we're going to adjust that in a little while. Every bit of this presentation, every bit of the illustration numbers you're going to show, which have column entries or titles, have information in the narrative that will help you describe those things, so that, again, even though you might think you don't know what you're going to present or talk about, you need to study this before you would. Excuse me. Got a little sinus thing going on here today. So again, here are your descriptions in detail, so you can read the information. But I know what you all want to see is what's going to happen on his retirement. So let's get to that. This page here is the actual summary and where the signatures take place. And this is page 7 of 15. You'll also note that everything in here, there's a date today that we're preparing it, the version that it's under, the MEC limit. The important thing here is when you do have these 15 pages, they have to match, because all the same information is at the bottom of each page that would be checked in case somebody tried to slide in a presentation or a illustration that they did after the fact. They had a signed signature page, and then they went back and reran it, and they added these other pages. It won't slide, it won't get by. Everything is attached. All right, so let's talk about it. Tabular values. Here's our premium payments. This is all on the guaranteed side. He's paying $12,000 a year for 29 years to age 65. It's guaranteed without any activity of the dividend benefit, that the guaranteed cash return on that product would be at that point $361,000, and again the same death benefit. But here's where things get interesting, because this product with his first $12,000 based on today's dividend return is going to give him an annual dividend that year of $358. We're going to use that to buy cash additions, okay? So that total cash value at the end, with the paid up additions of an additional $1,586, now his death benefit increased to $665.25, which represents the $1,585 of paid up insurance. What's taking place on this side, again, even though it's non-guaranteed, is all based on the dividend return that we discussed earlier. So as we're going through, you can see by the time he's 65 years of age, his dividend is huge. His dividend is much greater than, in fact, it crosses over at age 58, where he's actually investing 12 and getting a dividend of 12, which is again buying up more insurance, which continues to increase this death benefit. At age 65, he stopped paying any premium, okay? Now at age 66, he's still going to get a dividend, and it's going to add it to his cash value, and it's going to add to his death benefit, as it will for the rest of his life, because again, he's no longer going to pay a premium, but he's going to get the benefit in the increases in the value of the policy. So the first part of this illustration just shows what would happen if he went all the way out to age 120 and never paid another premium and just let the policy grow and just left it as an inheritance. And as you can see, it's a ridiculous number. Even at age 100, if he never took any money out, the policy that we started at 663,000 is projected to grow by, based on dividends, to over 3 million, almost $3.25 million. It's pretty phenomenal. Okay, so the next step though is, and we're only up to page 10 of 15 and we're getting close on time, we're going to look at what happens when we want to take money out, and we're going to do that. Again, we're going to run them to age 65. It's all the same. This would match up to the original pages. But when the clock turned and he turned 68, as I said, we took him out to 67. He's going to start taking out $46,000 a year as retirement income. He's going to take that out all the way, we projected, to age 91. He's going to do it in such a fashion that he never has this policy implode on him. There's going to be no taxable consequence. So if we look at that from age 68 to age 91, it's 23 years. Over 23 years at retirement times 46,769, he has taken out $1,075,000 in income, non-taxable. Just want that to sink in. Non-taxable. He paid over 29 years. Make myself a little note here. 1,075,000. He paid in $348,000. So $350,000 of paid in premium developed for him, income of $1,075,000, again non-taxed, which decreased and caused it to become a loan after about 10 years. And that decreased the death benefit, but still at age 91, he would have a death benefit of $328,000 to his estate. This would truly be a retirement plan. Now let's see if I can get back over here to questions. I know we're running a little bit longer than I intended today. And there aren't any at this time, so I know you've been very attentive. Thank you very much. We'll work on this a little bit more in another couple of sessions. We'll get over to doing some presentation work with a UL. The ULs that everyone seems to be interested in today are the indexed ULs. So I'm going to save this one. It's automatically going to save in my program, and we'll be able to look at that and do a comparison as well. Next week, for your information, we've moved the webinar from Wednesday to Thursday in order to facilitate the speaker, who is Michael Gendy. Michael actually was on the very first webinar we did this year, and he had some sales tips then. Again, he's going to have some more sales tips on setting goals, appointment structure and setting, and also some tips on the scope of appointment. That's going to be important for you as we go into that season just ahead. He's also going to introduce his short-term health home care product, which is brand new to Guaranteed Trust. And that is going to be next Thursday. So I apologize for messing up the schedule, but that was the best fit for him. And it looks like I'm going to have a conflict on Thursday. So I'm going to be requesting one of the resident or the other providers here in the producer services department to assist me and handle that webinar for you next Thursday. So until that time, Mark Conter signing off and letting you know again, if you have any questions, and I'm sure you will, call back in, talk to Producer Services Department, or talk to me, and we'll try to get those questions answered. Have a great week, everyone. Thank you.